Okay, Matt, let's dive into earnings palooza. It just keeps on coming, man. I tell you, we've got more companies reporting this week. We had a lot of companies that reported last week. And let's go ahead and kick it off here talking about Mastercard. Tell me what you saw for their most recent quarter.
Well, it was good. The stock popped right after the earnings, so you know everybody liked what they saw. Earnings were up by 33% year over year. Revenue grew by 15%. So anyone who thinks companies like Visa and Mastercard are maxed out, this proved them wrong once again.
I'm maxed out. I like that. You probably didn't even mean
no
to
pun
do
intended. But the things that really were encouraging to me were, one, cross-border transactions, meaning the international revenues, were up by 17%, which was the strongest of their main areas of growth. So that was very encouraging. And not only that, but their margins are getting better. Their expenses only went up 11%, while their revenues went up by 15%. And as we've said many times, anytime your revenue is growing faster than your expenses is a very good thing. Mastercard's margins were higher by over 2 percentage points. And the other really big thing that stood out to me was the kind of aggressive buyback that they're using. I know everyone's buying back stock right now, and it's kind of the buzzword of the day given the tax reform savings. But Mastercard not only bought back $1.2 billion worth of stock in the third quarter alone, they came out with their earnings report and said, we took advantage of this big market correction in October. In the first 25 days of October, they bought over almost $360 million more on top of that $1.2 billion.
Wow.
So it's really nice to see them being proactive and saying, we took advantage because we thought our stock was dirt cheap in the beginning of October, so we bought a lot more.
Well, as a Mastercard shareholder, I like everything you just said there. So let's keep it going in that direction there. Take a look here real quick at Fiserv. And Fiserv, this is an interesting business. I think it flies under the radar for a lot of people, but it's a really good business because it is the company that provides the software for a lot of these smaller financial institutions, smaller banks and whatnot. They provide the software for these banks to get their work done, the ledgers, the payments and whatnot. So again, it's a good business. The stock is having a decent year so far. It's pulled back a little bit here, but it obviously is benefiting from the growth in electronic payments. Generally speaking, from a business perspective, they benefit from switching costs. Banks don't typically like to switch operating systems very often. That's a pretty big undertaking. And so really what this means is Fiserv is a partner that grows with these banks and continues to offer more services. And what this ultimately does is gives Fiserv a little bit of pricing power as time goes on, and we'll see them exercise that here and there. But generally speaking, you're looking at a business that's going to continue to grow around 4 or 5% organic growth. But they really do a good job of bringing it down to the bottom line. And when you talk about those share repurchases, if we look at their share count going back to 2013 to today, they have brought that share count down 22% in that period of time. So they continue to do a really good job in buying back shares and helping realize value for shareholders. It's not something that's going to sit there and double overnight, but I think it's going to be a nice slow grower for folks looking for, some financial exposure there. And let's talk about Paycom as well. Matt, you went through their quarter. What'd you find?
More good things. Revenue and earnings were both up by 32 and 33% respectively. The reason I love Paycom, and they just announced that recurring revenue, it now makes up 98% of their total. If you're not familiar, Paycom's the online, the payroll processing software company. 98% recurring revenue is a pretty nice moat. This is a service that companies need. Businesses need to process payroll. So this is a great recurring revenue stream. It's growing at, like I said, a 33% year-over-year clip right now. And they're not buying back shares very aggressively. They said they bought back about 30,000 shares, which is, a drop in the bucket. But they're plowing all their money back into growth, which is exactly what they should be doing. If you can have 98% of your revenue be recurring and grow that at the same rate for another few years, you're they're going to be in really good shape.
Yeah, recurring revenue is a beautiful thing. We'll wrap it up real quick with Markel, another one of our foolish favorites here. We've talked about this business for many, many years, and it's our baby Berkshire, as we like to call it. But another very good quarter for the company, and we talk about the three main drivers of the business in the insurance underwriting, and they stood at $4.5 billion in insurance underwriting this quarter, $4.5 billion up for the first 9 months of the year versus $4.1 billion a year ago. And we also talk about their investment income, which was up to $320 million from $304 million a year ago. And then the Markel Venture side of the business, that's their investments in these smaller businesses, and they take meaningful stakes in these businesses. And I think they have somewhere in the neighborhood of 17 or 18 in the portfolio now. But that profitability, they brought in $1.4 billion in revenue on the Markel Venture side versus $933 million a year ago for the first 9 months of the year. So seeing some very good performance there in the Markel Venture side of the business as well. They just keep on doing a lot of the same things here, just running a smart business. And co-CEO there, Tom Gaynor, he's a leader we like. We've had a chance to speak with him a number of times. And so as a Markel shareholder myself, I'm happy to see that they're doing what they're doing. And I think shareholders should remain very encouraged about where this business is headed.